Hey guys, what's going on? Can you guys hear me?
Ew.
It was alright. Alright, so I have for the podcast, the video geared up and ready to go. Does everybody have the link in the Discord ready to go? For whenever they do launch it at 2:30, which should be about in a minute?
In 2 minutes. Yep.
Yeah. Sweet. Alright, so I will pull that up.
Yep. So, just as a heads up for everybody who's going into this, um, the market's already seeming to have a pretty negative reaction to whatever they're going to be announcing today. We have the VIX that's now all of a sudden spiking up, which is the volatility index, SPY and Dow Jones, which can be usually used as gauges for the overall broader market, seem to be having a downturn right now as well. Tech as an entire sector is getting hit pretty hard. We'll see what they have to say, but I suspect that's something to do with quantitative easing and them finally talking about how they're going to increase interest rates from here on out. So,
Yes.
here's hoping.
This is gonna be interesting. I actually forgot that this was today, so yay for having Kenna Hour at the same time. So yeah, for everyone in the Discord, it might be pretty quiet, so that we can all kind of pay attention. But oh, here we go.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have, specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early. Any barriers that you see keeping people from the labor market as you consider full employment going into 2023? Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I'd point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not, yeah, in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that would stop and that, in fact, it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though, although, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary. And we'll be we're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or an exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thanks.
Thank you. Now we'll go to Ilan Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you didn't haven't made substantial progress yet, but that you expect to continue to make progress in that discussion. Did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Right. So I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Ilan, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer term inflation expectations? And would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer-term inflation expectations, they've moved up. They moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good, actually, to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and they, by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago, at a time when inflation was still anchored and at around 2% or maybe even a little bit below. So the answer is yes, I think they are anchored, and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's important.
Okay, now we'll go to James Politi with the FT.
Chair Powell. Hi, thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment 4.5% and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023, showing not one, but two interest rate increases at the time, I mean, is this kind of, can you describe the sort of tone of the discussion in the committee, and are we really moving towards sort of a post-pandemic stance? Is there greater confidence that the recovery will be a full recovery sooner than expected?
On your first question, the judgment of when we have arrived at substantial further progress is one that the committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is the process that we're beginning now. At the next meeting, we will begin meeting by meeting to assess that progress and talk about what we think we're seeing, and just do all of the things that you do to sort of clarify your thinking around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the two hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. In our if you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff were very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the real near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Thank you. We'll go to Nancy Marshall-Genzer from Marketplace.
Chair Powell, continuing in that vein, when you're ready, how will you go about signaling the start of tapering when you do decide to do that?
So our intention for this process is that it will be orderly, methodical, and transparent. And I can just tell you we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And we expect to be in that business until we reach substantial further progress, and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think, but we're making progress.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can.
Great, thank you. Going to Craig Torres at Bloomberg.
Craig Torres at Bloomberg. If I were a businessman looking at the forecast today, I would ask how and when the Fed seeks to achieve an average of 2% inflation. In other words, does the FOMC have a look-back period, or does it plan to suppress inflation in outer years? Because over the next 3 years, you're going to be above inflation. So what is your look-back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
So as part of our year-and-a-half-long process, the review that we did and came out with at the end of that with the new statement on longer-run goals and monetary policy strategy, we looked carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that, and we concluded, and I strongly agree that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary. There's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time, and it's meant to create a broad sense that we want inflation to average 2% over time, and that under the old formula, under the old framework. What was happening was 2% was a ceiling because all of the errors were below. You were always getting back to 2%, so you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. You're right. It's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
That pretty much answers it, Chair Powell. Thank you.
Thank you. Now we'll go to Michael Derby.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility, and do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range, and I do think it could have some effect on broader money market conditions below, as it relates to the very low rates and the downward pressures.
Okay. And do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing, you would think that it would, but we'll have to see. It's possible that would not be the case. Well, that's going to be an empirical question.
Okay, cool. Thank you.
I will go to Gina Smialek, The New York Times.
Hey, Chair Powell. Thank you for taking our questions. I was wondering if you could follow up a little bit on your response to Rachel at the very beginning and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking decent. So I guess I wonder what full employment means in this context and sort of how you're thinking about those wage data.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages, and many different flavors of that. So, how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply outperforming expectations over a long period of time. Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window, because people would have retired anyway, and you'll be back where you would have been. So I think the lesson number one is just to be careful about assessing maximum employment, and I think during the last cycle there were waves of concern that we were reaching full employment as early. As 2012 when I arrived at the Fed, and 8 years later, we were still creating jobs, and it was quite remarkable. So we're all going to be informed by that. At the same time, we understand this is a different economy. The demographics people are getting older, and that should have a secular effect of reducing participation over time. So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling in the sense of what would be troubling would be very wide across the economy, wages at unsustainable levels. Without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy, sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs, and but we do think you've got a thing in the labor market right now where supply and demand are just not matched up well, and we think it's a flexible economy and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, but the last thing I'll say is again, if you look at the forecasts, we're going to be in a very strong labor market. Pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
Thank you. Now we'll go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the status of your thinking around the supplementary leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but We've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing. And because of the substantial increase in reserves, treasuries, and other safe assets in the banking system, the SLR is rapidly ceasing to be the intended backstop that for our big firms that we want it to be. So we do think it's appropriate to consider ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. So sorry, I can't give you any more. That's just something we're working on.
Thank you. Now we'll go to Anakin Tappa at CNN Business.
Hi there. Thanks for taking my question. Chairman Powell, the price jumps we've seen in some raw materials, lumber, for example, you mentioned it earlier, seem to be easing, and it looks like we're in the beginning of suppliers catching up with demand. But I wonder if you're worried at all if we're going to end up with excess supply immediately after those shortages wear off, and if we just continue this mismatch as we're recovering and getting out of the pandemic economy. And I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. But actually, people who work in commodity industries are very focused on that, because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly.
Thank you. We'll go to Howard Schneider at Reuters.
Howard Schneider, Reuters. Thanks, Chair Pell, for taking this. I don't want to miss the moment here, and I noticed that in the statement you dropped the language saying that the pandemic is weighing on the economy. So, is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
You know, it's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And you know that should continue. But you know, you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates. They've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and you know that can only help. You're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. You know, who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could follow up on that, if you view the statement in toto and the dots and the SEPs as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen inflation above target, though, and I think even though in our forecasters' case, they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecasts as well.
Thank you.
Thank you. We'll go to Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
So what we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023, those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change in the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do. But I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%, that it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi. Thank you for taking my question. Chair Powell, I'm just looking at the forecast, and the one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. But you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022, and 2 to 2.3 in 2023. So you're right. You're seeing. I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year. Coming on the back of a 7% growth year, that's a really good year. That's a year with a lot of momentum. That'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right?
The economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect to suggest that that longer term neutral rate or R-star might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount. And that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You know, you can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest, and we'd try to keep up with that, and I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. And I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements. But if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was, will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors in a particular, due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017, if you remember. There was prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that, and that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're going to watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
Okay, guys, we gotta talk about this for like a half hour at least. What in the hell? Alright, so I took notes. I took notes. I never take notes during these things, guys. Did anybody else in the team take notes? You guys are all muted, by the way, if you didn't know. So in summary, GME is the only hedge. I mean, AMC is too. Any of the meme stocks, really. I would say any of the meme stocks, anything that's shorted, because half the market's shorted. I mean, that's your hedge right now. We have other things that we're looking into too, commodities and whatnot. So, and we'll be covering that. I'm gonna set up a day, once we can have a full understanding of the things that we want to talk about. We're gonna set up a day probably next week and discuss how to kind of hedge against the economy. All right, so all right, I guess we'll dive into this. The things that stuck out to me, like these were interesting. So the fact that they don't have a template that they're basing on, like I understand that we're like in unprecedented times right now, but I mean, for the love of God, you're running our country's economy and our economic stance. You should probably come up with some kind of idea of what you need to be doing to safeguard us from economic disaster, right? Like it's just kind of how I'm feeling right now, and the fact that they're uncertain about how we need to be going is a little disheartening in a sense, right? And so that's all I have to say about that. Like I was like no template of oh boy, here we go. Um, they touched on the inflation rates uh, a ton, right? Like, and I feel like there's a reason for this. Like, to me personally, in my opinion, how inflation sits right now, they're not giving us true numbers. You can see this when you go to the store. Like, this is my best example. You know, last year we'd buy hurricane supplies. It was $89, and this year it was $208. Same exact thing, minus two things, minus two different things. Uh, there's no reason why the same amount, the same like order that we would put in, that it would go from $89 to $208. There's no reason for that unless at 2% inflation. That's not 2%. I know I'm terrible at math some days, guys, but that's not 2%. So that's just that on inflation. Like they're hiding inflation numbers. Um, So yeah, I'm trying to keep a hold of both chats here, Discord and YouTube. So I'm gonna prop my phone up right there so I can read Discord chat, and I'm gonna watch the screen too. So they were talking about the uncertainty about the true inflation in the near term. Like they're more focused on the broad long term inflation versus the short term, and I think that yeah, the reverse repos. That's gonna be shark bait. I'm waiting to hear what shark bait has to say about the reverse repos. We'll get down. I have that coming up, if he's still around and listening. But the concern I have that they're looking at only the long-term inflation and not the short-term inflation is that people aren't in work right now. I don't know where he keeps coming up with this whole thing that oh more people are really getting back to jobs and we have these higher wages. Like I was livid with that one. I don't know how many times he said that we have higher than ever wages and increased wages, and I'm going, who the hell is he polling? I'm sorry guys, this is probably not going to be a monetized video at all whenever that day comes, because what the hell? I don't understand that, because I want to know who he's polling and the fact that he's saying, "Oh yeah, the wages are higher than ever and people will be back to work and all this other stuff." Last time I checked, we're fighting. We're fighting as a country for minimum wage to be $15 an hour. Half my family's on unemployment, right? That or is unemployed. Yeah. That's I know a lot of people that are unemployed. I know a lot of people that own their business. Like we have our own business, my husband and I, and our photography stuff for real estate is going down the drain as we speak. Like I'm actually trying to figure out what the hell to do. So I don't know where that is coming from. I would really like to talk to the people where he's pulling that from. That everything seems hunky dory, and like I said, we're fighting for $15 an hour, and that's supposed to be just bare minimum to get through. It's pulling the bank CEOs. Yeah, he is easily, but that's I am so irritated right now. So then mainly looking at long term. Okay, so assets versus rate increases. So yeah, they're sitting there talking about like not being like concerned about rate increases, or just strictly looking at assets and stuff. Like what? I in my mind, this is a disaster. This is a complete disaster. If you're not looking at the whole picture, if you're not concerned about rate increases and you're just looking at strictly what the assets are being held, the assets can go down. That is a non-tangible way of looking at the economy and everything like that, because assets change. The value of assets change on, hell, we watch it on a minute basis pretty much. That is not a good thing in my opinion. Sharkbait, are you
Yeah,
here?
let me add a few things. So
Yeah,
I
go for
just
it.
took notes on four things that I said. I was going to tweet this out at some point, but now obviously we'll talk about it. No worries, Marissa. Powell continues to deflect on the bleak future.
Oh God, yes.
And our obvious state of impending hyperinflation, not even regular inflation, hyperinflation. I think the no increase to interest rate is actually delaying or furthering the can being kicked down the road into a potential implosion of the actual economy. And the way it's going, I don't feel confident in the dollar actually being of value for the at least next 4 to 5 years. It'll take a long time for the dollar to come back. He used COVID as an excuse, continued to use it as an excuse, and also downplayed that the Delta variant, which is actually the Indian variant, is in the UK and not in the US, which is bullshit. I think that's just not the right way of approaching it. This Delta variant actually is mutated, and it's known. Mark Tears Our Sweat is actually told us that it's in Canada and it's immune to our current vaccine. So you're probably not doing well if you have the Delta variant, because the current vaccines have no effect on it.
Yeah.
And then the great point you touched on was supply and demand, and the increase of assets versus rate increases is not the right comparison, because the valuation is the basis. So I don't think it's being seriously looked at, because they're comparing inflation rate increase to about 2%, where the way things are going, our inflation rate is at 5%. I presume by next month we'll probably be at around 5.3 to 5.4%. Just a slight uptick, because they are still printing the money. And unemployment rates are going to go up. I have a strong sense that they are going to go up.
Oh, yeah.
Because they're not doing anything about it.
Yeah, me too. I mean, I don't know how I don't know how that works. Like, people have had their eyes opened to the fact that the government believes that the 600, or was it the 600, 300 per week plus their regular unemployment is a livable wage. If the federal government pretty much screwed every business that said, hey, everybody's worth at least this much, and no one's going to want to go back to that. Like, no one's going to go work for poverty rates. That's not going to work. It doesn't. And these companies, they don't want to dish into their, or dip into their reserves. No one's going to want to, pay out more and take profits away. Like, that's not going to be a thing. So either we see prices go up and, so that people make more, or people are just not going to work because they're not going to get paid enough. Like, we are in a hell of a pickle. Like, sorry, Yanni, I didn't mean to cut you off, but I'm so baffled right now. I'm so just. Ani, do you want to touch on the reverse repos?
Yeah. I mean, I was going to actually ask Chris to talk about it, because I think that's one of the big pieces that when he mentioned it, the 5 points.
5 basis points. So I mean, like, that's not super significant. Yeah, it's not going to be a lot, but I'm just trying to think of like what the intent here is, and I can only assume that there's this longer term plan where the Fed is fighting the banks continuously. So I mean, like, who does this benefit, right? Like, them kicking the can down the road. Like, why make these changes? What is the intent here? And I personally believe it's because the banks have already shorted the treasury securities to such an extent that they're bleeding money every single day, which is why the reverse repo market participation is going up so much, and why they're kicking the can down the road, right? Like, why the Federal Reserve is like, all right, well, we're going to keep the economy alive for a little while longer, trying to make all these claims that, as long as COVID Delta is here and poses a risk, that we're going to continue kind of keeping up the baby gates on the economy. Which, I mean, like, whether that's required or not, I'm probably the wrong person to answer that. But ultimately, I think that they're very deliberately keeping the economy alive, and I think it's to explode some of these smaller players who have dug themselves a hole and who have these crazy short positions, which with these treasury securities. Which you have to remember, many of these securities that have been shorted are rehypothecated on top of everything. So these banks, they're in such vulnerable positions for every day that the economy stays alive, which I know is kind of a funny thought to think about, right? But um, it's clear that the Federal Reserve is fighting against them, right? And then they're showing them that they're going to keep things going for as long as they need.
I'd like to take the moment and actually disagree with you on the banks versus the Federal Reserve.
Yeah, go for it.
I think it is more likely that what we're seeing is the US economy basically having to defy all odds and come out of this corona pandemic that we're currently experiencing as unharmed as possible, since we're in a somewhat precarious situation with China right now. And if you think about it, what most countries are doing right now is paying people either money unconditionally or deliberately paying wages of people that would, still have employment if Corona wasn't around. What we see especially prevalent in Europe. So what this personally to me indicates is that the governments basically do not want the economy to go down because of this Corona pandemic. It might be, obviously, I would have to do more research on that, but it is very much possible that this is because of strategic reasons in terms of China.
Yeah, it could be. I mean, at the same time, I'm like, we don't have much evidence to believe that that's the case right now. Like, it is definitely a factor, but I don't think it's the main reason. I mean, you have to remember that you have this issue of rehypothecation, which I don't think the Federal Reserve has gone along with. Right? I don't think they've agreed to this, which is what the banks and short hedge funds are currently involved with. Right? Like the Citadels of the world. Then we bring in BlackRock into the conversation, and all of a sudden, I think that it is a lot more domestic in the short term, but I agree with you that it is probably to do with the international market in the long term for sure. That there's probably they want less people to deal with, right? So like you make BlackRock king, and then you deal with BlackRock as the sole liquidity provider. This makes it super easy to control and then be able to fight against players like China, right? So I guess we're both right, maybe here.
Yeah, I think the banks, to be honest, though, are playing a minor role in this. I think they just opportunistically went ahead and decided that shorting the U.S. economy would be a good idea. However, I also think that there's a long-term play involved with China, because if you think about it, it is one of the only countries that sort of can employ a strategy that outlasts its current government in a sense. If you look at democracies, for instance, especially with the US democracy, in my book, being prevalent in this, is that you have so many policy differences between the both parties that you cannot necessarily follow a single doctrine in regards to any given adversary, in a sense, for a longer period of time or an extended period of time.
Well, to me, it's right now there's a few different entities, countries fighting for the economic superpower, right? And we're with the states, we're having all these cyber attacks. Like, I mean, we've had an astronomical amount of them lately, and I don't know, like like I keep saying, I think that we're in a war without borders, right? Like it's really odd to think, like, because you figure you had our water line for like a fertilizer plant, like it was actually hacked and leaked into the Tampa Bay. Um, you had the oil pipeline, you had the subway in New York, you've had now the what was it, Southwest? No, was it Southwest? There's one airline, I can't remember which one, just yesterday. They had their computers hacked and grounded all the flights out of Atlanta. Like none of the flights were going nationwide. There's a lot of different outages going on. Texas last year had their power grid hacked, and so I think there's starting to be this, literal war without borders that America has blood in the water in the sense that they can see that we're a little bit weak right now, and our economy is struggling. They're trying to put on a good front, and I applaud them for trying. But anybody with two brain cells can kind of see we're struggling as a country. And you have China, you have Russia, you have other markets that are way more uh, stable right now in that sense, and they're coming after it. They're coming after that lead spot because if America can't hold it together, if they can't get their shit together, having the USD as the reserve currency of the world, if we tank, the rest of the world tanks. So they're trying, people are trying to take up that next spot. Like, okay, well, since the USD can't hold its own, why don't we use, the yen or whatever? So I don't know. Like, we're in really weird times. If you really take a look around, we're like there's like China's doing trade halts with Australia, and that's one of Australia's main resources, right? Like trading resources. And so I don't know. This is why Bullhouse exists, guys. That we have to look at the world. It's not just, we can't do this microscopic economic look at just two stocks, right? We have to look at the world and see what's going on. Because if we just zoom in on these two stocks that all of us mainly hold, we're going to get so screwed, right? Like this is where the voices have to be out there saying, guys, you have to look at the world because there's bigger things going on that they're not covering. You have to dig for it, yeah, but it's a scary time in my opinion. So I don't know. I think today him dodging all these questions, it was a signal that there's something big going on. Do you guys agree?
Well, you also have to keep in mind that obviously it would be very bad if a government official went ahead and basically said, "Okay, the economy is fucked. Pull out your money out of the stock market," while potentially politicians themselves still have money in the stock market.
So you mean
So,
it would be bad to tell the truth? Is that what you're saying?
well, the thing, the rationale behind this entire thing, and in my book, is that it is very possible to fix this situation without ever hitting hyperinflation levels. We will inevitably see inflation increases, maybe even up to 5% per year. But I think it is very much possible to prevent hyperinflation if tax plans get put into place accordingly, meaning especially the minimum tax rate for companies that has been decided on by G7 lately, the planned increase for capital gains tax, and all that kind of stuff can be used to, in a sense, drain the economy from money, thereby trying to deflate the currency again.
Yeah. But I mean that would require people to actually do their job and not take fat paychecks.
Yes, but if you tax people enough that take those fat paychecks,
Yes.
or even introduce a tax on simply equity, then the entire game would change.
But the tax is not the issue here, right? The tax is just a hedge. Again, the main issue is that it's the rate of goods and assets, the increase of it, which is causing a sort of an inflation for us, and then the current state of how so many different investors are in the market. I think this would be a different conversation if people actually had money. Right now, people don't have money, and so people understand the gravity of the situation. Because if they let these meme stocks squeeze and some other stocks level out, then the playing field will potentially a little bit sort of, in a sense, balance out, allowing us to fiscally be a little free and then it changes the whole game a little bit. And then you can talk about other things like taxation and whatnot. But right now, you're talking about taxation without even having the money in your hand. For a lot of these people, you're not really helping these small people, at least in a little bit, in their current state where they are, financially. That's just my opinion again.
Yeah. No, you're absolutely right. I mean,
Well,
if you talk, sit here and talk about, I mean, if you look at our economy, at least in the States, some of the highest taxed people are the middle and lower class. Like when it comes to the percentage of which you are taxed, the middle and lower classes are just they get screwed. And there is actually a game that I want my husband to start streaming for you guys, and like I want the actual community to actually hop on board and do it with them. It's like cityscape something something like that. But you basically get to build your own economy, and like you have to actually pick like different things like who to tax, how much to tax, how this is done and whatnot. It's like it is like a full like game of just building your own economy. So I think we're gonna do that sometime and get that kind of going as a community thing to see how we do it building up an economy. So it's let's just say we tried to build the economy in that game like the States is in, and it collapsed within like 200 years. And 200 years in the game. So don't rich people make up 90% of the taxes? I don't know that statistic off the top of my head because I would figure most rich wealthy people, whatever you want to say, they use tax loopholes. They'd be stupid not to.
I think you can cut this short to most rich people use tax loopholes. Because what you have to keep in mind is that those tax loopholes have the unfortunate characteristic in a sense that they only really start to sort of become profitable when you have 6 figures plus. Because there's a lot of effort you have to put into it. You have to open up shell companies. You have to have a business that actually makes money in the United States. And through convoluted ownership systems, you can funnel the profits that you made in the US out into other countries via intellectual property, for instance, which then allows you to sort of be cash zero in a sense for the US economy, but in whatever tax haven, the Cayman Islands, for instance, you suddenly
Of course
start
you
to
went
see
there.
a massive revenue for bullshit intellectual property rights. Like you wouldn't even believe what people have in terms of ideas to avoid those taxes.
Hey Rodriguez, how are you doing, buddy? Uh, oh, it's Tar Heel. Hey Tar Heel. Yeah, no, and that's exactly it. I mean, I mean, and I've read that numerous times that the wealthiest people I mean, they actually keep their bank accounts at a net zero. They don't have money in their actual bank accounts. They have it in certificates and bonds and things like that where they can just, they basically have a negative bank account at the end of the day. When it closes out, the bank cashes out some of their assets to cover their negative balance, and then they're back at zero. It's interesting. Um, all right, so let's see. Let's get back to the task at hand here. Going over this video. All right, inflation staying above 2%. He was saying that this is due to increased employment. I know Silent, you and I were kind of talking about this back and forth in the chat. So like my my gripe with this statement, and I'm now pacing because I just can't sit anymore thinking about this. So my gripe with this is that he said inflation would be due to the increased employment. So increased employment. And then he even went on to further say that we would have more people working to provide resources, but then again said the resources would then be all used up. He contradicted himself. And I don't see how, if people are back to work producing items and people are, yes, people will then have money to go buy said items, but if it's a constant buy, supply and demand, where the supply is there, the demand is being met, that's where it would stay stable, right? And I don't understand how he can sit there and say, oh yeah, we'll probably hit a 3%, maybe higher inflation because people will be going back to work. That doesn't add up. And I about flipped my desk because I was like, well, that's not how this works. That's not how any of this works. Like, correct me if I'm wrong, but if people are back to work, that's money that the Federal Reserve's not having to pay out for unemployment or anything, or the state governments or that paying out for unemployment. That's not people, using, federal assistance, food stamps and all this other stuff. It's asinine. It's like, okay, people are out, manufacturing cars, manufacturing chips for computers and whatnots, and cutting down lumber and whatever, in factories making bread, whatever the case may be. If people are out creating the product for people to buy, the supply would be there, right?
Well, theoretically, you would be completely right. Unfortunately, however, what we've seen lately is that the production industry, in a sense, the secondary sector of the economy, has been more and more outsourced to China. So what the US economy now mainly does is tertiary sector, meaning services, research. Like
Well,
the
right, yeah.
US is one of the countries that files the most patents on stuff. The US is one of the countries that produces most of the research. You have to keep in mind, however, that the tertiary sector is a especially precarious one. Whilst it does add into the economy in a sense, it all boils down to inflow and outflow of the economy. Because what starts to happen if you have a lot of imports for goods from a foreign country and not much export of goods to that foreign country, well, you suddenly start to see the amount of your native currency that the foreign country has increase. Well, if you have any to begin with, your stockpile of the currency of the foreign country decrease because you have a trade deficit. So what you have to do is either compensate for that by, charging more money for patents, for instance, or producing your own goods. Otherwise, you're running into the problem that money gets essentially siphoned out of your economy. You will start to have printing more. Or, worst case scenario, that foreign country decides that your currency is no longer worth it, decides to dump it on the market as quick as possible to exchange it for goods like real estate, commodities, gold, you name it.
Right.
And that devalues currency.
Well, right.
So if this should happen, and just to make this clear, with foreign country in this particular case, I mean China. If this should happen, then you are going to see a lot of inflation, because suddenly you will no longer be able to buy any commodities on the market, which sort of trickles down into the supply line.
Right, but I mean, but see, I guess that's where it drives me nuts, because it's not just because people are going back to work. It's literally like, it's the fact that he said it would be due to an increased employment.
Well, that again would make sense if actually no goods get produced in the US.
But I mean,
still importing.
We still have goods produced. I mean, hell, I can go 10 miles and I can go to about 20 different factories. I can go even further over to Orlando, and it's factory city over there. Like, there are still a lot of goods produced here. Yeah, a lot of it gets outsourced. That's unfortunate. And that is a very, like, I was actually talking with my stepdad today, or well, not today, last week, about it. And we are still a production company or country in a sense. Like, we still have a lot of production here. it is like you said, we do a lot of research, we do a lot of medicine, we do a lot of that type of thing, information technology type things. But that is still something that people have to buy out, right? Like people still have to purchase that and whatnot. It's like it's just turning we've just
Well,
kind of flipped what we specialize in, right? Like we're not doing we still have a lot of car manufacturers here too. Like I mean, it might not be American owned, but we have like if you look at Indiana, they have a ton of different car manufacturing factories up there.
Well, while you are right, yes, two things I would like to mention at this point in time, and I see we've got someone that requests to speak.
Yes, let's bring him up.
I'll let you in shortly, or I would like to state my point here before.
That's fine.
And so the problem that you have is that first off, in terms of the production, it is noticeable. The US right now is, as a matter of fact, not producing as many goods as it consumes, which which would not necessarily be a bad thing. But then again, if you look at the concrete example of China, and this is actually why I brought this up in the first place, is that China, in terms of their culture, has a deep disrespect in regards to intellectual property rights. The thing is, if you think about if you think about product piracy, the first thing that I personally associate with that is China. And if you look at especially designer clothes, for instance, a lot of that is coming from Eastern countries, not necessarily China, but I don't actually know the name. What is the country that a lot of the clothes come from? Well, I don't know. Anyway, point being,
I mean, China, Mexico, Vietnam.
Those sorts of countries. What my point is China has been notorious in the past for selling knockoff products of Western developments. Now, granted, that has changed over the past, but it goes to show you how much they would respect patents if it would come down to it. So you're exposing yourself by basing the majority of your economy on those intellectual property innovations or patents or whatnot. Then, if I were in a position where I, as China, would like to wage a trade war on the US, I personally would go ahead, pirate as much stuff as possible, copy their inventions without paying anything to them, while still trying to stay under the radar as much as possible so I can still continue to export my goods, catch up in terms of the scientific deficit by trying to pioneer a few select technologies, like, for instance, 5G manufacturing, AI, all kinds of stuff that China has tried to excel in the past. And then my next thing would be to gradually lower the living standard of the opposing country in order to get as many people to immigrate into my own country. So all of the stuff that I was not able to be the world leader in terms of research, those people simply move from their home country to my country because living conditions are better. That is the main problem with the tertiary economy. It depends on people. It does not depend on resources. It does not depend on manufacturing capacity. It depends on people. And people are free to move around. So, with that being said, if you would be able to get a lot of the smart people to move from, for instance, Germany, like has happened after the Second World War, to America, you suddenly would start to see that a lot of the innovation also gets moved from Germany to America. And the same brain drain, in a sense, could happen if the economic situation in the US worsens. Yes, Bangladesh. That's exactly the country I was talking about.
Oh. um, And I'm getting this told to me about 1,000 times. I know he said that it would eventually normalize. I do know that he said that, but it's one of those things where I kind of like what KMO was, what he also said, a pretext to blame the average working citizen when things hit the fan. That's what I have a concern with. Is like, how are they discussing this? And yeah, I mean, yes, and silent, like you bring up a lot of good points. Like, I think we are just going to have to. It's going to be wait and see, right? I mean, we can't predict exactly what they're going to be doing. Like, they we have a lot of bad players. You know, we have other countries that don't give a damn about what they do, as with China and their piracy. You know, they don't. No one cares. No one cares. No one gives a damn of who they hurt, how bad it hurts. As long as they get theirs, they're fine, right? Like, it's very unfortunate about how it's all kind of transpiring, right? I'm not able to wrap my head around a lot of that right now because I have to absorb the stupidity at this point. Hey Tar Heel, do you have a question? Comment? Tar Heel?
Does not appear to be the
Crickets.
case.
Crickets. Alright. So I can move on to the next thing. Um, let's see. He was talking about how everything's going up, right? Wages are going up, job market's going up, you know, more people are employed, more people, and I don't know. I have had a couple people, you know, say like, you know, through Twitter and whatnot, it's like, I don't know where this is coming from because we all know a lot of people that are still unemployed, right? We still know a ton of people that are without jobs and that are still working for $7, $8 an hour. That's not going up in my opinion. That's either going down or staying stagnant, and that, you know, the only thing going up is the cost of living. Uh, and when you don't have the income matching the cost of living, you're just asking for a disaster. Like our I can remember when minimum wage actually increased to, what was it, 7.25? I mean, it was incredible. It was incredible to see an increase like that. And that was back in, God, someone help me. Late 90s, early 2000s. It was God, I was a kid, but that should say something. I was a kid the last time we had any kind of change to minimum wage. I'm 31, guys. That's disgusting. That shouldn't be a thing. We've had war after recession after recession. Inflation, cost of living has been a thing ever since that last big increase to minimum wage, and yet here we sit. No one's able to afford the average life anymore. You know, we live paycheck to paycheck. I personally was looking to either we were trying to buy a home, but I'm kind of backing off that idea given current circumstances in the economy. And so we were going to go rent a house, a bigger house, because my parents do live with me. And I'm sorry, but I'm not going to go pay twice the amount I am paying here right now for my rent for something that's actually smaller than this. Like, for me to renew my lease, it's, you know, 100, I think they increased it by $100 to renew my lease. That is still half the amount for something that is 100 to 200 square feet smaller than what I'm in right now. That is disgusting. There is a big, big problem. And so I'm not 100% sure where he's saying everything's going up in the sense of, in a good way, that wages are going up and jobs, you know, there's more jobs available. I checked Indeed. I checked Indeed because, as I said, our photography business is hurting, and so I was, trying to see what kind of jobs. I have 2 degrees. I have 2 degrees. I am overqualified for the jobs that are available right now. I'm overqualified. I can apply to most of these jobs and they're going to laugh in my face and say, sorry, we can't pay you enough. That's the unfortunate truth. And I mean, I can try to find work from home, but guess what? That's what everybody's doing. Everybody's trying to work from home. So I'm not entirely sure where he's saying, oh, there's plenty of jobs to be had. Well, that might be true, but someone with an English degree and a medical background with a medical degree, I can't quite go work at fast food or a retail job. That's not going to work. And the medical jobs they're a fight to get. They are a big fight, and I've been out of the industry for 5 years. So it's a little disheartening to hear that, because it's not going to be the people that are, I don't know how to put this. The people without college degrees will be able to get jobs pretty easily. The ones that have college degrees and have had high-paying jobs and have a, resume that used to be able to flaunt, you can't do it anymore. My husband has an impeccable resume. He's worked at Apple and all this other stuff, like these big companies. And he applied to Lowe's. This is an actually fascinating story. He applied to Lowe's. He's a retired vet. He can't do big jobs anymore. He really just can't. He wanted a little part-time job to work at Lowe's. They turned him away because he's overqualified. Lowe's. Doing something very simple. Working out in the garden area. Something very simple. They turned him away because he was overqualified. I have no idea. I don't know what we and him are going to do if we have to close our business down. So there's that, guys. And then he kept talking about the framework's not flawed, which we'll have to dive more into that. But I did notice that he was kind of cherry picking their own data, like their forecast. He kept saying their forecasts. Their forecasts say that it's good. Their forecasts say everything's going to be fine. Well, what data are they picking from? What data are they picking from that everything's going to be okay? Because from what all we've found, what all of our group, hundreds of thousands or millions of people have been researching the market since January. And we're not seeing things that are fine. And if we're finding that, then shouldn't that be an indicator that things are not okay? I mean, any of my team, feel free, or Tar Heel, someone speak up, because that to me is not an indicator of things being okay.
Here's the thing, in my personal opinion, you have to give it to the man. He is right in the sense that the economy will go up. It just remains to be seen whether, it will go up in the traditional sense or it will go up, it will go belly up.
Yeah, yeah. Belly up or just straight up. Yeah, or are they just going to artificially inflate it? I mean, I think that's kind of what we're seeing with the, NASDAQ and the S&P and everything, what we're finding, because there's no reason that those indices should be going up still, given the current market situations. I mean,
you guys hear me?
Yes, we can hear you, Tar Heel.
Oh, all right. So, with the inflation, the government wants their money back real quick.
Yeah.
So there are a lot of jobs out there, but a lot of them are going to make you relocate. That's bad. The minimum wage really is set for teenagers in the real world that they shouldn't have. They are deferring the minimum wage to the employers. So my daughter, who works minimum wage here in Maryland, is $11.25 an hour, and she works at, what do you call that? Potbelly. My other daughter, with Target's minimum wage, was $14 an hour. Now it's $15 an hour, and she was a barista at the Starbucks Target, which is an offset. what I think is occurring here in America when they said there's lack of lack of people wanting to work is we have done what we tell our kids not to do. Do not feed wild animals. When you feed wild animals, they'll stick around for the free food.
Right.
But we have given 4 stimulus checks. I have not received a single one. And people are getting paid very, very well not to work. Plus the bonus stimulus money for unemployment. And all they have to do is phone in and say, I look for a job that hasn't or any in there, and without proof. That is bad. Now, when people say there's not a lot of jobs, not a lot of jobs that they want. For you with 2 degrees, we would hire you in our internship program in the government. As long as you have 30 business credits. And
Well, see, and that's
you
the
can
thing.
come to death lucky like me.
Yeah, and say I don't have 30 business credits. That my degrees are in English because.
And if you move to Maryland with your nursing, we will hire you because we are lacking nurses here in Maryland.
But Maryland's way more expensive than Florida. Like, you see
But
what
your salary is commensable. An average nurse around here makes about 95,000
Well, and
a year.
I hear that, but I mean that's cost of living and salary. I have the same. I saw my sister in here. I think she is in here. They live out in California. My brother-in-law just became an RN, and we have the same argument. She's like, "Oh yeah, we get paid a lot," and I'm like, "Yeah, but cost of living, the standard of living that we've come to appreciate. One, I like the warm weather. Two, I like my beaches, and I don't live that far from the beach, right? If I were to take where I live and how I live and put it in another state, that's how I do it. Right? It's not it's the size of the house, it's the cost of gas, it's the amount of groceries. And it does actually boil down to like California, when I did the comparison from California to Florida, it was the nurses out there actually made 10 to 15,000 less than our nurses here based on cost of living or something like that. So it actually
taxes.
with taxes, yeah, we don't have state income tax, and plus my husband being on fixed, income with his VA benefits, we don't get that state tax either. Like, so I mean, that's everything you have to factor in when it comes to having to relocate. So, I mean, and minimum wage, I actually just pulled this up because I've had this argument with people. Minimum wage was actually created to provide a livable life, right? Like you were actually supposed to make enough to be able to be comfortable. That's why minimum wage was actually created, was so that the employers couldn't exploit workers. They couldn't
Correct.
exploit.
It was a protective workers. But
Yeah.
look at the 21st century, right? We don't pay a nickel for a 6-pack of milk.
Well, right.
So the minimum wage, in my eyes, that should be deferred onto them into the employers. Right? It's just an act. So all they are is making the employers say $7 or $11 or $15 or $20 an hour. But in reality, what's going to happen is when that does occur, the product price will go up. Right? Why? Because of me and you. We're stockholders, and we want a certain amount of return. So I've seen the price go up in Starbucks coffee because it's 15 an hour. Right? Now, look at our strawberries, right? Strawberries in California or here in Maryland used to be $1.50 for a container. Now I'm paying $3 a container. Why? Because of the migrant workers are being kicked out.
Well, not even that. Actually, I can actually answer this one. Because Florida actually is one of the big strawberry farms.
Yes.
And last year for COVID, because we went to a local farmers stand and stuff, and we asked them, we said, well, where's all the strawberries? They had to destroy hundreds of acres of strawberries because of COVID. Hundreds of acres.
So Number one, that was government mandated.
Yeah.
They did that all. So you ask yourself, why did the federal mandate hit all the produce and the livestock?
Oh, I did. Yeah, I have a whole nother thing about that.
So I've been watching this, and for the last, I guess, few months. Well, I'll say since the election. Ever since the election occurred, futures market has been they have been trying to be manipulated into work in their favor. So then I looked at the lumber. Why is that escalation of prices? They said it didn't happen in COVID during 2020, so why now? Don't say lumber supply shortage because the truckers are still trucking, and they always have been. The production line and the logging has not stopped, or the wood producing, because in real is most of it's automated. So why now? Because people are starting to use more money, and they decided supply and demand, so they held down the supply from getting point A to point B. Same thing with the gas. The gas spiked because we had lack of qualified drivers. That's what they said. Or the government mandated them to stop trafficking gas as often as possible. Why? To make the gas prices go up. Because the price of crude oil has stayed the same, $50, $75 a barrel.
Yeah.
It's this market manipulation that the government's doing because they're invested in futures.
Right. And that's very possible. It's stupid. It is absolutely stupid how everything's so manipulated. Unfortunately, guys, for the podcast, I'm gonna have to get ready to turn this off so that my team can go have lunch or do whatever they need to do. But if you do, everyone that's watching on YouTube, if you do want to continue this conversation in the Discord, we will be in the break room area somewhere. You'll see us all. But yeah, I'm going to go ahead and call it the day on the podcast. That's pretty much all of our final thoughts. Does anybody else have anything they want to touch on before I say goodbye to our group?
Yeah, well, you did say, that we're not taking people concerned. Well, we, the EMC stockholders, are trying to squeeze the holy shit out of these hedge funds, and we're not even looking for the repercussions of how many people will be unemployed when these hedge funds go under.
Yeah.
Now, will they be unemployed long? No. They'll start their own firm.
Oh no, I always take them into consideration when people sit
I
there.
do not.
I do. Because there's innocent people with the hedge funds. You have to consider the receptionist. You have to there's people that don't have any idea really what's going on. They just kind of know because of social media now. There are innocent people in the hedge funds that'll lose their jobs, and that's unfortunate to me.
But they'll get rehired back. Why? Because a lot of the people, the high power hitters, they already know the KSAs of that receptionist, and she messes well with the team. So they just hire back with the new name of the firm.
Well, yeah, but I'm just saying, like, there's a possibility that doesn't happen. There are
And
possibilities.
she'll get a pay raise.
Maybe not. All right. Podcast, you guys have been awesome. Again, we're going to take this back down into the break room, and we will see you guys Friday.